If your leads, CRM, carrier appointments, client data, commissions, training, and product access, and ability to keep working all run through someone else's platform, are you really an independent business owner? That is the question raised in Brooks versus Quility, a Federal RICO lawsuit filed by former agent Jackson Young Brooks against Quility, Symmetry Financial Group, Quility Financial Advisors, and several individuals. And nothing in this video is a verdict. These are allegations from a complaint, and the defendants deny any wrongdoing. The court has already denied Brooks' emergency request for immediate relief, and the case is facing early legal challenges. But the allegations raise serious questions that you should understand if you're an insurance sales. So let me share my screen, and we're going to dive into this behemoth of a lawsuit. So let's go up here. I downloaded this from Brooks v. Quility, Pacer Monitor. I paid for it, and then I downloaded this. I've also got the Witherell case and a Centron case that I'm going to be going over with you guys. If you haven't already watched the Centron one, go back, do that. It's big if you're interested in agency ownership, if you actually own it, which this one actually talks about. So let's go into this. These are Jackson Young Brooks against Quility, Symmetry, Quility, Matthew Goforth, Michael Resma, Brian Williamson, Lisa Kimbrell, Chris Lee, Craig McManamon, Sierra Smith Simmons, Jeff Sigworth, and Tim Taylor. Who is that from Home Improvement? Tim the freaking tool man Taylor. All right, so it's not against him, but just making a joke out of that. So preliminary statement, this case challenges a nationwide insurance distribution network that generated revenue by defendants' operation and management of a deceptive mortgage protection consumer solicitation regime that misleads customers through mortgage reference solicitations, monetizing those responses as leads and selling those leads to insurance agents while retaining centralized control over every meaningful aspect of the agent's ability to work and earn income. Now, this is big. The reason this is more aggressive than a normal contract dispute is because Brooks brings it as a RICO style case. He's not just saying I was treated unfairly. He's claiming the business model itself was a part of a broader deceptive enterprise, essentially, in my own words, a scam. Now, that's a huge allegation. That also means it's way harder to win because RICO is not easy. The preliminary statement will give us the whole story. He alleges that the defendants operated a nationwide insurance distribution network built around mortgage protection solicitations. He claims that the consumer responses were monetized as leads, like I just said, sold to agents, and then the company retains control over the agent's ability to work and earn. So he says the case challenges a nationwide insurance distribution allegedly built around deceptive mortgage protection consumer solicitation regime, where consumer responses were monetized as leads and sold to those people as leads. So the lawsuit has two audiences right here, consumers and agents. And consumers allegedly received misleading mortgage protection solicitations. Agents allegedly bought into a system where they were told they were independent, but the company controlled the machine. So if we finish reading this, plaintiff was one of many mortgage protection insurance agents recruited through interstate representations that he would operate an independent business and own his book of business, yet that independence never truly existed. Defendants dictated how agents solicited consumers, which products and carriers could be accessed, how commissions were routed, and whether an agent can continue operating at all. All essential activity was required to run through defendants' proprietary platforms, ensuring that agents remained economically dependent on the system they paid to participate in. In my own words, what this means is the agents are essentially the customers of the IMO. I don't like that. Number 3, plaintiff raised good faith concerns about deceptive and unlawful conduct. Defendants did not correct the misconduct. Instead, they coordinated pressure, concealment, harassment, and enforcement to suppress him while continuing to deploy the same practices against other agents and consumers. And when the plaintiff blew the whistle, defendants conspired to make an example of him. Defendants removed plaintiff by issuing him a letter from counsel that locked him out of all platforms, stripped his carrier appointments, deprived him of purchase data. He bought the leads and then he took them away from him? What? And business records, and falsely portrayed his removal to state regulators as voluntary and non-retaliatory. These actions destroyed the plaintiff's livelihood and were undertaken to silence reporting and protect a revenue model that depends on deception, control, and retaliation, not just against the plaintiff, but as a regular way of doing business. So jurisdiction and venue, this is where the lawsuit becomes relevant to every insurance agent. He alleges that they were classified as independent contractors, but Quility and Symmetry controlled how agents obtained consumers, what products could be sold, what carriers could be accessed, and how commissions flow, what business could be conducted, and whether an agent could continue operating at all. So down here, Quility classified Symmetry agents such as plaintiff as independent contractors and were referred to internally as mortgage protection agents, field underwriters, writers, or insurance agents. Quility or Symmetry did not provide agents with wages or salaries. Defendants determined the manner and means by which insurance agents obtained and solicited customers, what products could be sold, which carriers could be accessed, how sales were conducted, how commissions flowed, what business agents could conduct, and whether an agent could continue operating at all through defendants' infrastructure and proprietary digital platforms. Defendants designed a series of business systems so that agents could do everything under one roof. Interesting. And with that came the agent's inability to function outside of the proprietary platforms and sales system once onboarded. Plaintiffs were required to conduct all business through Opt CRM. Access to these systems were mandatory and used for all essential aspects of agents, such as reporting submitted business, agency and policy tracking, licensing and contracting infrastructure, client data access, training materials and modules, and advanced markets routing pipelines. Without platform or carrier access, an agent could not receive or retrieve leads, contact consumers, submit applications, service policies, receive commissions, or access business data and records. And Symmetry leadership, including agency owners, retained unilateral authority to grant, restrict, suspend, or terminate access to these digital systems at any time. Defendants' infrastructure was designed to lock agents into defendants' distribution channels by controlling their access to leads and consumer contact information, carrier appointments and contracting, compensation structures, and commission routing. What else do we got over here? So that's pretty much it for just that part. So the complaint alleges that they controlled consumer access, all the products, all the sales, commission flow, business activity, and whether an agent could essentially work through their infrastructure and platform. So that is the real question. Independent contractor on paper or platform dependent worker in practice? That should be the question you're asking, because if the company controls the leads, this is layman terms of what's going on. If the company controls the leads, the CRM, the carrier appointments, the policy data, the commission routing, and the login, then the agent may technically be independent, but practically independent. The model could be flawed from the very jump. So let's go down here. What he's saying right here is Quility HQ and Opt CR, the agents allegedly had to use for essential business activity, and according to the complaint, without platform or carrier access, an agent could not receive or retrieve leads, contact customers, submit applications, service policies, receive commissions, or access business data. Small business, that's not a small detail, that's the whole business. All right, so if one login controls your leads, clients, commissions, appointments, records, your business is only as independent as your access. So now we're going to go down to the mortgage protection side. Symmetry was formed as a mortgage protection sales company and designed it to target mortgage consumers nationwide, primarily via U.S. mails with digital advertising. Since Symmetry's founding in October 2009, the revenue model has been built around mortgage protection insurance solicitation as the primary consumer acquisition and revenue channel. And then down here, defendants and their leadership staff communicated uniform new agent and recruiting representations, established standardized training systems that funneled new agents into mortgage protection insurance as their entry point. And plaintiff and similarly situated agents were directed to prioritize pervasive and deceptive mortgage protection sales processes. I've made some videos on this in the past, especially on my Facebook. If you go follow me on there or Instagram, you'll see a lot of the stuff that I say. So follow leadership approved sales frameworks. What do they know about sales? And treat mortgage protection as the principal path to production, advancement, and recognition within defendant's system. Now, Brooks is allegedly saying that Symmetry is built around mortgage protection insurance solicitation as the main customer acquisition channel. And he said that new agents were funneled into mortgage protection as the entry point, trained on approved product hierarchies and directed towards specific carriers and branded products. What he alleges is that Symmetry's business identity and revenue model were built around the mortgage protection solicitation, and that agents were trained to prioritize mortgage protection, specific carriers, product hierarchies, and branded products. So here is the question this really raises. Were mortgage protection leads giving consumers clear life insurance options, or were the mailers creating confusion that agents then monetized? And again, this is Brooks' allegation. It is not a court finding. So if we go down here, we're going to see some retaliation and whistleblower allegations. And we're just going to use the judge's summary of this. So when we're looking at this, this is their prayer for relief. This matter is before the court on the plaintiff's emergency motion for temporary restraining order, a TRO, and preliminary injunction. So on March 10th, 2026, proceeding pro se initiated this by filing a complaint asserting a wide range of claims against the alleged unlawfulness of the defendant's business practices. The defendants are insurance sales and marketing entities and additional individuals affiliated with those entities. The plaintiff generally alleges that the defendants operated a deceptive and unlawful insurance distribution network and retaliated against the plaintiff by terminating him after learning that he had filed a whistleblower complaint with the Louisiana Department of Insurance. And on March 30th, the plaintiff states that upon his termination, he lost access to certain systems and client data managed by the defendants. And to mitigate that exposure, he seeks a restraining order, and he wants preliminary injunction to prevent the defendants from enforcing post-termination provisions. With orders and preliminary injunctions are both extraordinary remedies involving the exercise of very far-reaching power to be granted only sparingly and in limited circumstances. To obtain temporary or preliminary relief, a plaintiff must establish that it is likely to succeed on the merits. 2, it is likely to suffer irreparable harm in the absence of relief. And 3, the balance of equities tips in its favor, for the injunctive relief is in the public interest. Down here, the plaintiff asserts that he faces ongoing professional harm, financial harm, legal exposure, and potential exclusion from his industry. Pursuant to the plaintiff's independent contractor agreement, the ICA with Symmetry, the plaintiff may be subject to chargebacks for commissions that he has already been paid but has not yet earned. We are advanced commissions. So if an insurance policy for which Symmetry paid the plaintiff an unearned commission lapses prematurely, Symmetry may demand repayment of unearned commission as a chargeback. Accordingly, the agreement characterizes an unearned commission as a loan to the contractor until such premiums become earned. Most of the plaintiff's present concerns about professional and financial harm appear to stem from his chargeback exposure, and he received an email 8 months after termination from a Quility employee that directed him to contact a policyholder regarding a potential chargeback exposure despite plaintiff's lack of authority or system access to do so. So the court summarized Brooks' allegation this way. He claims the defendant operated a deceptive and unlawful distribution network and retaliated against him by terminating him July 15th of 2025 after learning he filed a whistleblower complaint with the Louisiana Department of Insurance. The judge orders that Brooks alleges defendants operated a deceptive and unlawful insurance distribution network and retaliated against him after learning he had filed that whistleblower complaint. So that gives the case its motive theory, so to speak, its narrative. All right. So Brooks says he raised concerns, reported them, and then got shut down over it in retaliation. But the judge has not ruled that this retaliation has actually happened. So we need to go look at the emergency injunction loss, which is all of this. And because the plaintiff's appointments with insurance carriers were terminated upon the termination of his position with Symmetry, the plaintiff subsequently needed to reestablish his appointments with insurance carriers in order to continue selling their insurance product. However, according to the plaintiff, he has been unable to reestablish some of those appointments with carriers because he remains subject to chargeback obligations because he has outstanding debts to certain insurance carriers. For example, he states that he was terminated by Aetna following chargeback-related activity. Emails submitted by the plaintiff tend to show that Aetna terminated with Aetna because the plaintiff failed to pay a $2,400 debt. The plaintiff states his relationship with other insurance carriers have also been negatively impacted, probably because he's got vectors or anything like that if the chargeback is correct. And it states that he has failed to offer any non-conclusory allegations regarding whether and to what extent he continues to possess unearned commissions that could be subject to a chargeback. The plaintiff was not, in fact, directed to contact the relevant holder in an email received is contradicted by the plaintiff's own evidence, allegedly. So here's a lot of people would conveniently skip over. Brooks has already asked the court for emergency relief, and the court denied it. He asked for a temporary restraining order and preliminary injunction. He wanted the court to stop defendants from enforcing certain post-termination processes and provisions to stop them from directing him to take or refrain from policyholder-related actions. So the judge's reasoning, more than likely right here, is the court said emergency injunctions are extraordinary remedies. To get one, Brooks had to clearly show likely success, irreparable harm, balance of equities, or public interest. And then the court focused heavily on irreparable harm. Brooks argued he was facing professional harm, financial harm, legal exposure, and potential exclusion from the industry. But the court said money, time, and energy injuries are usually not enough if compensatory relief could fix the harm later. Essentially, they can just wave the magic money wand and make problems like they never. That does not mean Brooks lost the whole lawsuit. It does not mean he'd meet the high bar for emergency relief. And this is why Brooks is a harder case than if you looked at my Centron case. Centron has a cleaner fact pattern. She's a alleged agency owner promise, alleged carrier termination emails. Brooks is trying to attack the entire operating model. That makes Brooks more explosive, but also more vulnerable. Me personally, I would like to see all these agents win their cases. But RICO is very difficult. The more massive the accusation, the more specific, the more concrete the proof has to be. A court is not going to let a plaintiff turn a normal business dispute into racketeering just because the complaint uses dramatic language. Now, whether Brooks wins or loses, you should pay attention to the structure he is attacking. I'll go back full screen for you so you can see my devilishly handsome face again. All right. So there are some questions you really should ask yourself. Who owns your leads after you buy them? If you pay for leads but you lose access when you leave, did you buy an asset or did you buy temporary access? Did you buy a login? All right. Number 2, who owns the client data? Can you export your clients' notes, policy info, and contact records freely? Who controls carrier? Can you continue writing with carriers after leaving, or does the platform relationship control your access? Number 4, who controls your commissions and chargebacks? What happens if you are terminated but still responsible for chargebacks? Do you still have to pay those, but you can't do anything to service those policies, try to maintain the relationship with the client? Number 5, can you actually operate outside the platform? If losing HQ or CRM access stops your ability to work, you need to understand that before you build there. Number 6, is your independence practical or just contractual? A contract can call you independent while the operating system makes you dependent. So the question is not whether the contract says independent contractor. The question is whether the business can survive without the company's login. And this is why Brooks and Centron belong in the same conversation. Centron essentially asks in that lawsuit who owns the agency. Brooks asks in this lawsuit who controls the machine. But together, they raise a very brutal question for agents. Are you building a business or are you buying access to someone else's business system? So my personal opinion is this. The Brooks case is a lot harder legally than Centron because it is broader, pro se, and built around RICO. But the agent lesson is still serious. If your lead, CRM, carrier access, your commissions, your client data, and policy servicing all depend on a platform you do not control, you do not own, then you need to stop calling that pure independence. Before you join any IMO, ask one question. If they shut off my access tomorrow, what business do I still own? Now, do you think agents are truly independent if their entire business runs through company-controlled leads, CRM, carrier appointments, and commission systems? Drop your answer below. So that is the Brooks case, and this is not a verdict. These are allegations. Can't stand that word. Allegedly. And the defendants deny any wrongdoing, of course, and the court also denied Brooks' emergency request for immediate relief, which means he did not meet the high bar for a TRO. or preliminary injunction. That does not mean the whole lawsuit is over, but it does mean this case still has major hurdles. But here is a lesson for agents. The lawsuit raises a question every agent should ask themselves before joining any IMO. Like I said, if your lead CRM, carrier appointments, client data, policy records, commission, and your ability to keep working all depend on a platform you do not control, how independent are you really? And that is the real issue. That is the real bitch of this industry. Not whether a contract calls you an independent contractor, not whether a recruiter says you can build your own business. The real question is, what do you still own if the company shuts off your access? Because if one login controls your leads, your clients, your carrier access, your policy data, and your income, then your business may be only independent until the login stops working. So I want to know where you stand. If an agent pays for leads, builds a book inside of an IMO's system, but loses access to the CRM, carrier relationships, and client data when they leave, did they build a real business, or were they just renting access to one? Drop your answer in the comments. So before you call yourself independent, ask what happens when the business stops working. And to end this video, your business is not what you produce. Your business is what you still control when the relationship ends.